Hey guys and girls, welcome to this week's episode of the B.Invested Birchy podcast. I'm your host, Nathan Birch. This is the show unraveling the truth to the facade of the 21st century when I exit the matrix and waking up to motherfucking reality. Reality it is. We've got Sumit here from Zinger Finance. Thanks for coming on.
Thank you for having me, Ned.
Pleasure anytime. I'm really excited to chat to you today because we did a podcast last, like maybe 3 or 4 months ago.
Yeah, 4 months ago.
4 months ago. And we were talking about infinite lending, and everyone thinks that you can set up a trust and you can outsmart the system and all that sort of stuff. And I said at the time, I thought it was like a Ponzi scheme. That was my words, not yours. I'm un-PC. You're very PC. But yeah, my words were that it's, I forget what it was exactly.
A lot of people just go, just buy trust. But if they come in and close that loophole, which they always do, they can do around it, it will impact you as well.
You just have to be sure that what you're buying is not purely based on policy-driven mechanisms, right? So that you can actually then stand the test of time.
My words were that, this isn't sustainable in that podcast. And we talked about the pros and cons of setting up trust, not doing it by trusts. And we always analyze the risk. And you're the man that's in demand. You've got a team of like 20 staff in your team at Zinger Finance, and you're writing loans for the most interesting, 0.001% of Australians with large property portfolios. And everyone, like we just recently had for those of you who are not aware, we just hosted Buyer, which is the first buyer's agency conference in Australia, where we had a few hundred buyer's agents turn up, and they're all collaborating and learning and had specialists in. And then Sumit, you got caught up on the stage. You spoke for like 5 minutes. Like, hey, you got caught on a bus. You didn't even know it was coming. It was like, hey, up on stage. We want to talk to you first, right? And then everybody was texting you afterwards. Like everyone, somehow the presenter had asked Sumit, hey, give everyone your number. And then you gave out your number, and every buyer's agent wants to use you now because of, your expertise in being able to structure, and understanding bank policy and, all that. So there's a little bit of an intro for you. The last 2 weeks, 3 weeks have been very interesting times. We've seen APRA come in, change policy at the banks, Macquarie pulling out of trust lending.
Yep, CBA
The
as well.
CBA.
A bit of a
And
pullback.
probably by the time this goes live next week, someone else will pull out of the market.
Yeah.
Are you concerned at all for our clients or what we do?
No, not really, because like most of the clients that we have been working with, they have been building up the property portfolio of like 10 properties to 15 properties. Some of them have even 33, but everything is in personal name for them.
Yeah.
So there are only few of them who use trust, but that's for specific reasons why they want to do it.
I heard about it. I was like, it doesn't really affect our life. I've had another few. We don't have Ridwan here. Last episode we had Ridwan as well. It's just something on the topic. The fear that I have is everyone's been pushing this trust, put in a trust, get your accountant to sign off on it or whatever. And we've spoken about it at length, me and Ridwan from an accountant, he's the accountant, about the fact that like people are getting this advice from social media and TikTok and whatever. Everyone's an expert, but they're not considering all the full risks, picture and risks.
And because there are a lot of risks associated with it as well. Like Ridwan would have like
the tax,
tax side of it. So it's not an advice, but like if you set up multiple trusts, there's operational cost. Because you have to get your accountant to get things done every year. Which could be like if you have 10 trusts, that's like maybe minimum 3,000 per trust, which could be 30,000 a year. That's going out of your pocket. If your property is negatively geared, it gets trapped in. If it's negative 5,000 per trust, that's another 50,000. And if you think about it over the term period of how long you're going to hold on to that properties, it could be like 100 to 500K.
Massive.
Massive.
And I think that's something that the penny will drop, the lights will turn on in like 2 years' time, 3 years' time, when people start getting impacted on that front. But we're not here to talk about tax today. None of this is tax advice. None of this is financial advice. We're just here with Sumit from Zinger Finance talking about what's happening out there, what options are there, who will it affect, is there pits that'll plug the market? Have you seen this happen before?
So If you remember, like a few weeks back, I was just chatting with you. It's like, I feel like it's going back to 2017, 19. I can see the pattern that the lenders are getting fined. And then there could be some more restrictions coming in. And then that's when we got the news from APRA as well, putting the DTI restriction to 6, which is very similar to 2017 to 19.
Break it down. I'm a dummy, right?
Yeah.
What is DTI? What's DTI?
DTI is debt to income ratio.
Okay.
So what they have mentioned it's not like totally restriction. I would call it restricted allocation to the lenders, because they have given an allocation this time saying 20% of your new lendings books needs to be like it's only 20% that they will allow you to have a DTI of 6. So debt to income ratio is, let's say your total debt could be 500K, and if your income is 100K, that's like 5 DTI. And your debt could be your credit card, personal loan, car loan, all the debts, and your income could be your income from your job, your income from your business. With business, then again, the banks has different way to look at it, and your rental income as well. So if the clients are purchasing high cash flow properties, then that helps you to make sure you keep your DTI below 6. So it all depends upon what kind of strategy you're using, what kind of asset you're getting. That will like help you navigate through this market cycle.
I just think like we're already seeing a lot of first home buyers coming in, taking up that cheaper stock with the first home grants that are out there. The people that can't afford to spend $1 million for a house, like there's going to be a lot more people seeking positive cash flow than ever beforehand now, or like a higher cash flow, which will put more pressure on my market. Will make my job harder for my investors, but I guess it's good for all our investors because their properties just keep going up, which is cool. But on a taking on more debt, that's interesting, right? So the average income's like 100 grand a year or something, 80 grand a year or whatever, and if the average income's 80K, that'll mean that a debt to income ratio of 6 would be like 520 grand or something.
Yes. So if it's 80K, then somewhere around 480. 480K. Yeah. But it's very interesting how these restrictions have come into play, because APRA as a regulatory bodies has different measures and tools that they use to ensure that the economy is doing well, or if the clients are going into financial hardship or not. Like we have seen servicing restrictions, like when I said servicing restriction, they used to implement floor rate with the banks, which they handed it back to the bank in, I think, 2019, where they're like, okay, you determine the floor rate within your own lending metrics. Then the other servicing restriction is the buffer rate, which they changed from 2.5% to 3% in 2021. So when I said buffer rate, let's say if your interest rate that you're getting in lending is 6%, then the banks will assess it at 9%.
9%,
And then that applies to your existing loan as well if you have loans. So those kind of restrictions are more implemented by APRA and regulatory body to protect the client from getting into financial hardship. Is there's a interest rate shock, like this fluctuation. If it goes up like too quickly, then that will protect you, because they are assessing that you will be able to make the repayment at 3% higher rate than what you're getting. And then there are other kind of restrictions and tools that they use, which is like loan to value restrictions. I haven't seen that happen here, but I've like read that it has happened in like other countries, where they will only allow you to get like, let's say 75% LVR or 60% LVR of the security. Here we can only see those kind of restrictions based on the location, but not specifically applied by the regulatory bodies. So that is second tool that they use, and the third tool is the DTI, debt to income ratio. And my understanding, because I'm a student of finance, accounting, economics, so my understanding is they're implementing this more towards like making sure that the price of the properties doesn't go high. Because with the supply restriction in Australia for the housing, and then the high immigration, because they need to make sure they mitigate the dependency ratio, which is increasing in Australia. And the fertility rate is low, which means they have to get people in, which is high migration. That increases the demand for housing. And the other thing is the factor that the government came up with the schemes where they're helping people get into the property market. First 5% low deposit scheme, no LMI. And they're like help to buy, those kind of schemes, which has increased the demand, which is good that government is trying to help the people to get to the house, but that has increased the demand. So the supply is less, demand is high, which means the price would go up in future. And that's where I believe most of the investors started to predict the market, and they're like, okay, we need to get in. That increased the demand again. And the other aspect is when I think it went a bit the other way around, is when the government removed the cap for income from the first home low deposit scheme. And that applied from October this year, which means we'll only see the impact of those next year, January, February, March, because most of the people would like to get a pre-approval before they buy a house. And then they are predicting that, okay, the market might go crazy, the prices might be pushed up too high. That's when they apply, I think, DTI restriction, because they usually apply these to make sure that the purchase price or the price of the property doesn't go too high. And then if you read that article,
it's a good article.
I've highlighted a few things. It specifically have few aspects.
This is from the news back in the October the 6th, 2021. The article, if you want to go read it, we'll put a picture if you're watching it on YouTube, but that will put over an image that says APRA tightens lending rules to target property boom. And reads, APRA has decided not to implement debt-to-income limits for now, which were being speculated as a potential move, saying these would operationally complex to deploy consistently and could have resulted in higher interest rates for some borrowers because lenders would have lifted rates to ration credit to get under the limits.
It specifically says consistently they can't. So it could be a bit temporary. And there are a few other things that's highlighted in the second and third page.
This is from the RBA back then, which we can't believe what the RBA says, because they said the interest rates would go up in 2024, but in 2024, 2025, they started coming back down because they pushed them up so high. But anyway, Reserve Bank on Tuesday said that it was important lending standards were maintained and serviceability buffers were appropriate. APRA said targeting the buffers as opposed to other measures such as floor rate or debt income limits would be more effective in restricting investors' borrowing.
So it says investors borrowing over there.
And it says here, debt to income constraints above 6 times are clearly more serious, but the banks don't have the data to implement them, and they wouldn't be too effective to counter large loan size and house prices.
So it's like, the thing is, if you think about it, demand supply, the push of demand because of new government policies coming in, that means the purchase price would go up, and the only measure they could apply was a DTI at this period of time. Because if it was, it hasn't mentioned that it's specially targeted towards the investors. But the information out there says something different.
I find it to be interesting because there's another boom that's going to happen. This is for another video. But we've seen large levels of migration. People don't just come to Australia and go, okay, cool, I can buy a house today. They've got to rent for 3, 4, 5 years. They've got to get their residency, whatnot. What we haven't seen yet, we're starting to see this first homeowner grant boom happen. But imagine what's going to happen in another 12, 24, 36 months as those migrants that have come through in 22, 23, 24 start becoming residents and citizens. They'll be getting access to the first homeowner grant. They'll be able to go in with 5% deposit that they've worked really hard to go and get themselves into a property to really cement their place, and is bringing all those people from the rental market into the buying market. And there's the next boom, which is rocket fuel.
I read an article where it says with the first home loan deposit scheme, they had helped somewhere around 237,000 people to get into the property market till now. And they're expecting every year somewhere around 73,000 people to.
Crazy.
It's
crazy. I just saw that the first round of co-government buying is coming out now as well. Like that.
The help to buy?
The help to buy, where they go like 20%, or you put down a 2% deposit, the government takes like a 20% stake in, and
I have an article if you want to read about it.
Let's have a read through it. It's pretty cool.
So if you read this one, this is the
imagine all this, like 2%. If you need 2% or whatever it is to get into the property, Here we go. I'll just read the article and I'll go into what I'm thinking, right? Help to Buy example. Nura is 28 years old, works as a primary school teacher in Geelong, Victoria. She dreams of buying her first home in the city, but she lives and works. The current market price in Geelong is around 750 grand. Nura has managed to save 50 grand for a deposit. Her bank has indicated she can borrow up to 550k. That leaves her 150 grand short in being able to afford a home. After checking her eligibility, Nura finds that she qualifies for the Help to Buy scheme. Throughout the Help to Buy scheme, the Australian government can contribute 20% shortfall of 150,000 bridging gap, making it possible for her to purchase his first home. Thanks to Help to Buy, Nura can have achieved a goal of home ownership, something that she would not have had possible without the government support. It's all just a big Ponzi scheme. It is all just a big Ponzi scheme, because what's that allowing her to do is her 50 grand can now stretch to borrow another $2 million worth of value, really. Like,
yep. And it specifically says over there the serviceability with the lender
is only 550.
Yes.
Yeah.
So they are not doing any, like, there's some eligibility criteria we have to go through to the calculation and so. But what they are saying is he can only borrow like certain amount with the lender, and then the rest of the funds is still being contributed by the government.
So here's the thing, right? I'm just reading on. You haven't highlighted any of this, but this is how Help to Buy works. You save a minimum of 2% deposit, right? So you can buy $1 million property with 20 grand. Just sell your car, get fucking credit card. Like, people can get access to 20 grand. They can't get access to 250 grand. They can get access to 20 grand, right? That takes everything to $1 million with 20 grand. Like, that is batshit insane. It means everything we've got is just going to get dragged up, inflated away. Yeah. Crazy. When you buy a home through the Help to Buy scheme, you own the home but share some of the value with the government. As the Australian government has contributed to purchasing the property, the government will proportionally share in any gains or losses made when you sell the home, or when you buy out the government's equity share. It doesn't have any terms and conditions about the government's equity share there, but it's a very interesting position. It's just such an interesting thing, and it's like they have a problem, and how can they make this big bubble get bigger and inflate more air into the bubble? They're always coming up with these things. So we've got a convergence here. The 5% scheme where you put down no deposit, like put down 5% LMI, and then now you've got the Help to Buy scheme. There's schemes running on top of schemes.
So that will push the demand up
even higher.
Yeah.
And there's pressure globally around the world for interest rates to come down.
Yeah.
Which this tightening, in my view, is the same thing that happened back in 16, 17, and 18. We actually went into a bit of recession in Sydney market and Melbourne markets. There were some issues there. The markets that were overcooked came off the top. The markets that hadn't done anything for a good period of time had boomed. So Perth boomed, Townsville boomed, Gold Coast boomed, Adelaide boomed. These markets that were dead boomed. The markets that were at the top and overcooked fell backwards, and they came down in value, only for a short period of time. And then there was an issue, a medical issue. We all know what that was. And then they removed everything. Whoever could buy, just throw the kitchen sink at them. So it just makes me think about it. It's like, well, what does the future of this look like? In my view, is that it's something that'll happen a year, 2 years, whatever. It will hurt the people that haven't been smart, diligent, cautious with what they're buying and their asset selection and whatnot. It'll impact significantly a lot of the speculators that are sitting there, cheering on the market speculative wise. The people that are owning the assets, all these government grants will just add rocket fuel to the inflation levels of them. And then when we have some sort of crisis, it might be a health, I doubt it would be, they don't normally double them up, but there'll be some sort of crisis that'll happen at some point. They'll have to drop interest rates all the way back down to zero or negative or whatever. And then that's where the next blow off top cycle could be. That's just my personal viewpoint. Not putting words in your mouth, but you've seen these things happen a few times over the last almost 10 years.
Yeah, and with the DTI restriction, it might not be there for a long period of time as well. It's like it's a measure to control the price.
Yeah.
So if that goes up, goes back, they might put some other additional restrictions, which could be
worse, could be better.
Yeah, could be better, could be worse.
Yeah.
But then again, for the like people out there, it's like debt to income ratio. It clearly says total debt to the income ratio.
Yeah.
So if you don't have bad debts, like personal loan, car loan, try to minimize those kind of things. Yeah. You might still be able to get around with the lenders, and that only applies to the banks.
I was just about to ask, like, is this every lender out there? Like, there's how many lenders? There's like 300 lenders in the country or something. There's lenders that people don't even know how to say the name of. There's so many of them.
So they call it ADIS, Authorized Deposit Taking Institution, which is banks. And this restriction is specifically with those lenders. Like banks, and they somewhere around 123 of ADIS.
Of those banks,
Yes.
Okay.
So it doesn't apply to the non-bank lenders.
Okay.
So there are a lot of non-bank lenders out there who we have been working with our clients and investors. The interest rate is good. Their servicing
They're almost
is
the
good.
same.
Yeah, their servicing is good. Some of them are even funded in the back end by the major lenders.
It's kind of funny, right? Like,
yeah.
Don't for 1 minute, folks, think that the bank don't want to deal with you. Like, the bank wants everybody's business. They're in the business of getting market share. If the bank can't lend to you the way that they want to lend to you, they'll find another way to get their money out there so they can pay a piece of the pie. And a lot of these lenders are bankrolled with. I spoke to a lender the other day, and they're like, "Oh, I've got money here to lend to you. It's coming from another bank." And I'm like, "Fuck, this is pretty cool. That bank isn't too nice to deal with, but you've got a facility of $1 billion here that you can, it's how they get it to you." And
And I had a chat with a couple of our BDMs, right? We have a very good BDMs who understands like how we work, how our client base work. And like when I was speaking with them recently, they were like, okay, with the APRA coming in with these restrictions with the banks, so they are expecting flow in their channel. So they have started to hire more credit people so that they can facilitate all these loans that coming on their way. But some of these like non-bank lenders, their service is pretty good. They have started to do like desktop valuations nowadays, which was not
only the before banks. Like
the interest rate is not that bad, but the servicing is better than the first year lenders because first year lenders has 3% buffer rate. These lenders have 2%, 1%, 1.5%. For purchases, some of them even have 1% buffer rate.
Wow.
The interest rate is relatively higher than first year, but then again, you can get a bit of an extra funds over there to meet your goals and objective of what kind of properties you want to acquire. So they are very solution based.
I'm desensitized to what interest rates are. Like, what is an average interest rate today on like, say, if you went to a big four bank or whatever?
So for investment loans, we are getting somewhere around 5.8, 5.9 interest only. That's sub 80%. We usually do sub 80%.
Yeah, of course. And what would one of these second tiers or non-bank lenders charge?
Somewhere around 6.29% interest only.
It's like 50 basis points. So you get shit.
Some of them are a bit relatively higher than that. But then again, that's a solution, right? If you're in the acquisition phase of the properties, if you're building up your property portfolio, and also it depends upon the risk appetite you have. If that is what you want to do, you want to acquire too many assets, and you have a risk appetite to do it, then that could be a solution you're looking for.
Let's just run the numbers, right? If we got 200 grand loan, say an average loan, 200 grand, 200 grand loan at 0.5%, that'd be $1,000 a year, $20 a week. People go, "Oh, I don't want to get it." Well, you pay an extra $20 a week. Put the rent up $20 and the tenant's paying for it. It's like, the goal for investors should be accumulating asset, not, I'll save $20 a year.
So there's a lot of those kind of lenders. They're coming up with different policies, which favors investors at the same time. So when one door closes, the other opens. So you just need to make sure you navigate your journey throughout the process. You understand your risks. You have done a bit of a due diligence in regards to what kind of asset you want to buy. If you want to buy the high cash flow properties, like what you source for your clients, then it's like you might be able to find your way throughout this cycle of the market.
We've got investors that we've bought for 15 years ago, 10 years ago, 5 years ago, and current, and they've all challenged different issues. There's been different cycles, different hurdles, good times and bad times. There was a time when you started being a broker where trust loans wasn't even a thing. It was like no one took a trust loan because there wasn't even a product for that. It looks the rate that they're going that there won't be a product afterwards, right? But we've seen these things come and go. We've navigated in different markets. But if you have a solid strategy for wealth building and solid strategy for accumulating assets, these things are just, okay, well, which do I turn left or right at this intersection? How do I get around to where I want to be? Do you think that people will still be able to build a portfolio of 10 or 20 properties in 2026?
I think so because it all depends upon the risk appetite of the people as well, right?
Yeah.
Because it's not an advice again, but like let's say, if you're building up a property portfolio, you might be refinancing your property every now and then.
Yeah.
If your interest rate is relatively higher for the time period, you might not be there in that specific situation for 30 years.
Yeah.
The loan is for 30 years. The loan contract is for 30 years. But you might be refinancing that when the market changes.
Exactly.
And then you need to make sure that you do your due diligence if that's the right asset for you or not.
Yeah.
And if that asset has grown in terms of values and the rent, then that might help you with your property portfolio in future.
I've seen so many people over the years who go, I'll just wait until interest rates come down to buy. And it's like, well, when interest rates come down, it's going to be too late, right? You missed out. And it's like a 1% interest rate on a 200 grand loan. That's $2,000 a year, $40 a week. $40 a week, your rent goes up next year by $40, who cares? But the big thing is accumulating the asset. And I see people that make silly decisions every day, or they might be scared or fearful or whatnot, listen to the news, buy into something, whatever, and then not be pulling that trigger and playing at the game.
Yeah.
Yeah.
And like with this restriction, there will be some delays in terms of processing with the lenders.
Yeah.
Because if everything, the market is moving towards second-tier lenders, non-bank lenders, then they need to have enough resources to get everything done.
Yes. I've seen times where it takes 5 weeks for, it was at ANZ and stuff like back in certain periods, like the big 4 banks when they had high, like Corona, there was like lockdowns in different countries that had staff, the support staff, whatever. I remember seeing the agents would be like, you're a liar. These deals don't take 5 weeks for the bank. Is your client serious or whatever? But a real estate agent won't understand what the bank's dealing with, and a borrower doesn't understand the back end of a bank policy and all that. So I think it's very important you said that, because we want to make sure you guys understand Sumit's here, the team's here making the loans happen. But if it takes 4 weeks for the bank to pick up the file, it ain't Sumit's fault. They just don't have their shit together at the back end of the bank. And be prepared for that.
And with these restrictions coming up with a bit of a tightening of lending market, there will be some lenders will be getting a lot of volume.
Yeah.
And even now, some of the lenders are 5 weeks just to pick up the file when you lodge it, right?
Crazy.
We find our way because we have a good relationship with the BDMs. We have a good volume of applications going over there. So those kind of lenders are giving us some special services, looking after our files and getting it done quicker than the normal service level for any other brokers or any other brokering firm out there. But then again, with these restrictions, I'm expecting some kind of delays in terms of processing with the lenders.
Yeah. So there you go. Make sure you're preparing your agent. If you're dealing with us, we'll work with the real estate agent. That's what I do as a buyer's agent. But if you're working with an agent directly or whatever, make sure you're giving yourself the required runway if your broker or bank is, you're going to be facing these challenges. So, So we've touched on the DTI and the APRA tightening. I saw an email recently. I got 5, you sent me the email, then I had about 5 people send me the email that their brokers had sent that are external, just different clients and whatnot, saying about CommBank not allowing you to do trust lending now. Is that what happened there? What happened with Macquarie? Can you give everyone a bit of a rundown? And
so what happened with Macquarie is they used to have this policy with trust, where if you can set up one trust, buy one property in there, and then set up next trust number 2, trust number 3, trust number 4, and have one property or up to 4 property investment properties within that trust. And then if it's self-sustainable, then they would kind of isolate it every time they do servicing.
Yeah.
But the thing is, people, I think, started to abuse the policy.
Yeah.
They found a loophole in there, and they started to do like maybe marketing through social media. And
every second Instagram post or buyer's agent or spruiker or expert or broker or advisor will be sitting there going, "Oh, infinite lending, speak to us today," right? I actually fear that a lot of brokers will be in trouble because their whole business is just based on that. Like they haven't got like a toolbox to go, okay, that's one option out of 50. They go, that's the only option. And I think a lot of people will be stuck, whether it be buyer's agents out there, whether it be mortgage brokers out there, going, okay, our one trick's gone. What do we do now?
Yeah.
Interesting.
Yeah, but the thing with the trust lending is one of the reason why they had to pull out of the specific policy, and they specifically mentioned that social media influencer was one of the causes why they have to get rid of that.
Yeah.
Because at the end of the day, then again, the regulatory body and the bank has to do the right thing for the client.
Yeah, of course.
And if those properties, if anyone has purchased negatively cared and all those things, it will start to affect their finances.
I fear that there'll be a lot of people out there like, how many people would what percentage of people would be buying out a trust, do you reckon, on average with Zinger?
With Zinger?
Yeah.
Very nominal, maybe 1 or 2%. It also depends upon why.
1 or 2%. As a broker, so 1 or 2%, right?
Yeah. That's why, like when we had that previous podcast and it was mentioned infinity borrowing, I said there's nothing very infinity borrowing. We can maximize and navigate the journey by pushing like different things because there's different kind of lenders in the market with different policies, because everyone wants to do business.
Yeah.
Otherwise, there'll be only one lender in the market.
So there was never this amount of lenders that there is today. And it's understanding that policy, which you and the team, you're just constantly churning through that data and looking for new opportunities for people to be able to, proceed and grow. I've seen videos. I'm not on TikTok, right? I think there's a TikTok channel that the team have put together for me. But someone sent me these TikTok videos. I can't even watch them with that. They don't play because I don't have TikTok. But I saw one, and it's like a video of me. I've seen it 3 times now, actually, being reposted by different people. It's a video of me. Then it's got someone out from me from like 10 years ago on the news going, "Oh, I've got a few hundred properties, whatever." And then it's like, if you want to be buying properties like Nathan Birch does, speak to us because he sets it up in trust and this and that. The next thing I'm thinking like, who the fuck are you posting my video for starters? You don't know anything about me. You're completely wrong, right? But they use my face and videos, using that to try and pump their strategy like this. It's kind of ironic that, I've actually been used as like clickbait for people. It's funny.
Yeah, but once that Macquarie, like they pull out of the market in 2 different phases. First, like context was, they mentioned that, okay, we are only going to do maybe 1 trust moving forward.
Yeah.
And then in a day or 2, this is
candid.
Yeah. And then we got an update from CBA. They gave us 24 hours if there's any application for trust that needs to be like to all the brokers. When I said us, to all the brokers, that needs to be done.
Every broker in the country.
Within 24 hours.
Yeah. So, and I think the CBA one said that the client has to be a client with CBA for 6 months.
At least 6 months.
At least 6 months before they'll consider a trust. And they're not getting rid of it, but they're obviously restricting the shrapnel fly from. Yeah. One thing I remember, we've got a client. I should actually try and get him on for a podcast. I'm going to get some clients in for podcasts, so we're going to share their journeys and whatnot. It'd be more fun than me talking about how great people are if I can bring them in and they go, "Oh, it's what I've been doing," right? But we've got this client, and I can't get it out of my mind because it was about 3-4 years ago. I bought for this guy 20 years ago, and he got 20 properties, let's say, and they're all under his personal name, and he's got all this wealth, all this equity, properties all tripled, whatever. And he wanted cash flow. And I said, "Look, we need to go buy some blocks of units and stuff, whatever." And he goes, "Yeah, that's cool." He goes, "But my accountant told me I need to have a trust." And he I want him in the trust. I'm like, oh, whatever, just put him in the trust, whatever. Started buying, sent him over to Zinger. And then team's trying to work it out. I remember one of the brokers had said, the client can't service because of the ad backs, because the ad backs were trapped inside the trust. And it was like discussions, because it was like, you make a decision what you want it in the trust. You can't get a loan for the trust, so you can't buy the property, so you go in the trust. Put in your personal name, you don't want in your personal name, but you can get the loan. And he bought them under the things, and they've tripled. Those things have tripled as well. They pumped for him. But it was that point that it was like, hang on a second, the trust can actually hold you back. So all the people that have gone and bought all these properties in the trust, they thought they were outsmarting the system, but in turn, they could have screwed themselves up from sitting at the table with another lender and getting their portfolio to double over again.
Yeah. So how it works is there are different lenders, right? Yeah. Some of the lender will negatively gear the investment loan under trust. Yeah. When I say negatively gear, the property could be positive, neutral, negative, anything. But for our calculation purpose, the servicing calculators with the lenders are built in that way.
Yeah. The 3% buffer or whatever inside the...
Yeah. So whatever investment loans is for the servicing purpose is tax deductible.
Yeah.
So in the servicing back end of the calculator, it add back certain amount of money per month as a add back income.
Yeah.
So with trust, there are three different policies. So some lenders will isolate the trust. That's a different thing. They don't want to know anything about it. They just want to know that if it's self-sufficient or not, which needs to be the accountant needs to verify it.
Yeah.
And then once it's verified, they will completely isolate it. Right. And the second kind of policies where the lenders will not negatively gear the investment loans. Yeah. That's where the servicing gets negatively affected for the clients who are purchasing under trust. Yeah. And their lenders will negatively gear it. Yeah. For certain number of certain investment loans under trust. Yeah. For those kind of lenders, if the policy change in future where there's more restrictions that comes in for the trust, and they said none of the lender can use negative gearing for the investment loans under trust, how I believe ATO does, not an accounting advice or financial advice. Yeah. Then what happens is everyone will fall under that one specific policy where investment loans under trust are not negatively geared. There's no negative gearing add back in the servicing calculator. Yeah. In that case, the servicing will be drastically affected because let's say if it's a 500K value property, 400K is loan amount. Yeah. 500 per week is a rental income. We add back somewhere around 600 to 900 in the calculator per month as a part of add back income. So that is huge. Yeah. So let's say in next few months or in future, if that specific policy change where they're more restrictive in towards the lenders who are negatively gearing those kind of loans, where they shouldn't be, then everyone falls into one specific policy, and that policy will start everyone will get stuck with that aspect.
It'll pancake.
Yeah, if you have purchased too many properties under trust, and you have to go and disclose all those properties because you have to as a
you'd be worse off than buying with your personal name.
Yeah.
Interesting. That's why it's important to have the right team around you, I guess, and everyone understanding the goal, the outcome, and collaborating. I spoke to someone yesterday. They got 15 properties. They don't use Zinger. Actually, no, they don't. I don't know if they do. But he said, my broker told me the next property I buy, they all have to be under the trust. And I'm like, well, go and speak to the broker about that, right? It's, but that one person that you trust in that gives you advice, you need to look at everything. Don't trust anything anyone says. Look at everything, right? Don't trust what we're saying. We're just some crazy dudes on the internet, right? Make sure it works with your goal. Make sure that everything makes sense. Make sure that you can see the risks, the benefits, and make that educated decision. Because there's so many advisors that aren't on the same page and they do stuff that's going to screw each other up.
As a broker, we don't even advise client to do this or that. We just give them educational information that, hey, you need to go and speak with right people if you're planning to do something under trust, which would be your accountant, and get advice from them. Yeah. Because we can only tell them this is what the product is, this is how it looks like, and these are the policies with lender and how it might impact you in future.
Yeah.
So we give them all the information so that they can make a sound decision.
Yeah.
And I think that's more important, so that they have all the information upfront.
Yeah.
Because sometimes they might be thinking about, oh, I'll get this one under trust.
Yeah.
And then they don't realize, if they haven't done the research, if it's cash flow positive or neutral.
Yeah.
And then they get into that specific situation in future where the policies change like it just did.
Yeah.
And they're just stuck.
I remember I've seen times where accountants advise to put properties under trust, and it's like it's a principal place of residence. Like, you're paying capital gains tax and you're paying land tax on it, right? I've seen people have vacant land, no other property, and it's this little block of land that's got like stupid land tax on it, and they put it under the trust, and all the expenses are under the trust. I'm like, I remember
eating up their cash flow,
trapping it all in there.
Yeah.
And I remember once I said to someone, I was like, whoever gave you this advice, delete their number, never speak to them again. You know, like it's terrible, terrible advice. And it was like accountants and financial advisors just looking at one aspect without looking at it holistically. And I always say everyone should be their own financial advisor. Get the advice, speak to all the parties, look at everyone, go, okay, where does this fit in? What's the overall picture? Make a decision based upon that.
How it will impact your next couple of steps if you're trying to build up a property portfolio.
Yeah.
Like, what if the policy changes?
Yeah.
Because it can't be a policy driven strategy, because otherwise you'll get stuck.
Yeah. It's a season. It's unsustainable.
Yeah.
Cool. Any other feedback you want to share about the finance market at the moment?
There's a lot of movements happening in different sectors with different lenders.
Mm-hmm.
There could be some restrictions like this coming, which is a part of a market at the moment, right?
Yeah.
But then again, there are solutions out there as well.
Yeah.
Like, there are lenders coming up with like 1% buffer rate or even lower than that.
Yeah.
Like, where they are providing those solutions to the investors.
Yeah.
So we have got a couple of lenders coming up with no buffer rate for investors.
Perfect.
So there are those kind of product, but then again, like, we as a broker, we make sure everything is in place. We do our numbers calculation correctly to make sure that the client, they don't go into financial hardship or so in future.
Yeah.
That's our best interest duty.
Yeah.
But like, if you are planning to start your investment journey, if you are trying to build up the property portfolio, like, you need to make sure you speak with the right people. You need to make sure you need to get your next couple of steps lined up, not just the first one. Because like, first one is very important, but every step you need to know that what are you going to do next.
Yeah.
Otherwise you'll just get stuck.
Yeah. Whenever I'm buying a property or I'm speaking to someone, it's like, what is this property going to do to get me into the next one? And how's it going to assist in the bigger picture? Which I think a lot of people just focus too much on, I've heard this, I've been told this, or this sounds good today, or what about this? It's like, cool. Awesome, Sumit. Well, thanks for coming on and sharing all your wisdom. Like, whenever you hop on the videos and the podcasts, things go crazy, you know, like, people are always, oh, fuck, bring that guy back, I want to, and the comment last time, maybe we can share some on the screen, like, it was like, I've learned more in this video than I have for the last 5 years and stuff like that. People, your wealth of knowledge is fantastic, Sumit. So thank you for sharing that. How do people get in contact with you and the team?
So if you want to get in touch with us, send us an email at info@zingerfinance.com.au, and our team will get in touch with you to book an appointment.
Fantastic. Awesome, Sumit. Very in-demand guy. So thanks for coming on. If there's more changes shortly, we'll be updating you. Be diligent with your decisions, make decisions with discernment, and make calculated and educated decisions. So if you need help, reach out to Sumit and the team at Zinger Finance. Reach out to us, you know where to find us. Share, give us a like, leave us a comment, and we'll catch up soon. See you next Thursday with the next podcast. Bye for now.
Like Bilal said, man, we're stuck in the matrix. This my advice, don't care if you take it. The dollar back to die, soon to be hyperinflated.